Welcome back. In the last video we discussed that how depreciation is calculated using the full year policy of depreciation and monthly basis policy under straight line method. In this video we will be learning that how the depreciation calculation differs using these two policies but under reducing balance method. So let's begin. The example says, example number 3 means the first two examples were discussed in the last video for straight line method. So this example says a machine was purchased on 31st of August 2018 for $30,000. So we have what? We have the purchase date and we have the cost as well. It further says that it is to be depreciated at 10% per annum, means per year, using the reducing balance method. So now we have the rate and we have the method. The policy is to charge a full year depreciation in the year of purchase and none in the year of sale. This means that this is what? A full year policy of depreciation question. Okay. Now, it was sold on 31st of July 2021. So, we have the disposal date as well. And the year end of the business is 31st December. Again, very important information. The requirement is simple, that is to calculate depreciation which is to be charged in each of these years, that is from 2018 till 2021. Okay. So, we have the cost, we have the dates, we have the rate, we have the method, the policy, everything, right. Now, be very careful that the method is reducing balance method, and we know that how do we charge depreciation under reducing balance method, that is on the net book value of the non-current asset and not on the cost. Just in the first year we will be using the cost, but not from year 2 and onwards. So, let us begin. The first year is 2018. We will be following the vertical format in order to calculate depreciation, because that makes it really easier to charge depreciation every year, because you do not have to calculate the net book value again and again for every year. So, in 2018 the cost is $30,000 and the depreciation will be charged on this cost $30,000 multiplied by the rate, that is 10%. Now, should I further allocate this depreciation according to the months, that is should I multiply it with the number of months for which the asset was there in the business, that will be from September till December. Should I do this? No, I cannot do this, because I know the policy is full year policy, that is full year depreciation in the year of purchase. So, even if this was purchased just 4 months before the end of the year, I will be charging depreciation for full 12 months. Okay. So, I do not have to multiply it according to the months, and this will give me a depreciation of 3,000 for full year in the year of purchase, which means that my net book value will be $27,000 at the end of year 1. Now, let us move to year 2, that is 2019. My depreciation will be in this year, it will not be on the cost but on the net book value. So, $27,000 multiplied by 10% will give me a depreciation of $2,700. This means that my net book value will be $24,300. Okay. Now, let us move to year 2020. Remember, the year of disposal is 2021. So, in year 2020 again, the depreciation will be charged on the net book value, that is on $24,300. So, 24,300 multiplied by 10% would be 2430. This means that I will have a net book value of 21870. Now I am standing in 2021. How should I charge depreciation in the year of disposal? In this example, the asset was sold on 31st of July 2021. That is how many months for how many months this asset remained in the business in 2021? For first 7 months. So, should I charge depreciation for first 7 months on this asset in 2021? Can I do this? No, I cannot, because the policy is again to charge full year depreciation in the year of purchase and no depreciation in the year of sale. So, even if this asset remain in the business for first 7 months, there will still be no depreciation charge in the year of disposal, because I am following the full year policy of depreciation. Okay. So, this means that the accumulated depreciation on this asset would be $3,000 plus $2,700 plus $2,430. So, this is how we calculate depreciation if Number 1, we are following the reducing balance method, and number 2, we are given with the full year policy of depreciation. Now let's move to the next example, in which we will be required to calculate depreciation using the monthly basis policy, right. So the same example, this machine was purchased on 31st August 2018 using for $30,000. So we have the cost and we have the date as well. It further says that it is to be depreciated at 10% per annum using the reducing balance method. Very good. Now the policy is to charge depreciation according to the months of ownership of the asset. That is, we will be following the monthly basis policy. The machine was sold on 31st of August 2021, very important date, and the year end of the business is 31st December. Okay. Requirement is to calculate depreciation, which is to be charged in each year, that is from 2018 till 2021. Now we will be following the monthly basis policy. Okay. So what will happen in 2018? The rate will be applied on the cost, right. So the cost is how much? It is $30,000. The depreciation will be $30,000, that is cost multiplied by the rate of 10%. Now should I just stop here and take $3,000 as my depreciation in the first year? Can I do this? No, I cannot, because I am following the monthly basis policy. So in the first year, that is in the year of purchase, for how many months did this asset remain in business, this machinery? From September till December. I won't be counting August because this was purchased on the last date of the August, right. So from September till December, that is September, October, November, December, for 4 months. So for only these 4 months should I charge depreciation in the year of purchase, right. So this means that I will multiply it with 4 months and then divide it by the 12 months in order to charge depreciation in the first year. So this will give me a value of $1,000 only in the year of purchase, right. In the previous example, when we were following the full year policy, the depreciation charge in the first year was $3,000 because that was for full year. But right now I am just charging depreciation for only 4 months. That is why my depreciation in the first year is $1,000 only. This means that my net book value is $29,000. Then let's move to the next year, that is 2019. Now my depreciation will be on the net book value again, which is $29,000. So $29,000 multiplied by 10% for full year, because this remain in the business for full year. So $29,000 multiplied by 10% would be $2,900 in the next year. This means that my net book value will be $26,100. Let's move to the next year, which is 2020. Again the depreciation will be charged on the net book value, and that is 26,100 multiplied by 10% would be 26,100, which will give me a net book value of 23,490. Now I am standing in the year of disposal. So now how should I charge depreciation? On the cost, on the net book value, should I take it according to the months or not? What do you think? So in 2021 I will be charging depreciation, of course, on the net book value, and that is 23,490 multiplied by the rate 10%, but for how many months? Not for the full year, of course. For how many months? For the first 7 months only, that is from January till July, because then it was sold at the end of the July. So from January till July it will be 7 months. So for first 7 months only in the year of disposal I should charge depreciation on this non-current asset. So this means that 7 months divided by 12 months will give me the depreciation in the year of disposal, and that would be 1370. So this will give me a net book value of 22,120, right. So how we charge depreciation using reducing balance method? If we are following the monthly basis policy, we will be charging it according to the months of ownership in the year of purchase and in the year of sale as well. So this means that my accumulated depreciation in this example will be $1,000 plus 2,900 plus 2,610 plus 1,370. Right, so this is how we charge depreciation using reducing balance method if we are either given with the full year policy or the monthly basis policy. Okay, so that's it for this video. See you in the next one.